In the name of God, the most merciful, the most beneficent. This is for CMA Part 2 paper and Chapter B, and this is the first unit that we will be discussing risk and return under corporate finance. What is corporate finance? Corporate finance is concerned with how businesses fund their operations in order to maximize profits and minimize cost. We will be seeing what is the objective of corporate finance in the next slide, and we will understand more in detail about this. In addition to managing capital investments, long-term and short-term financing goals, corporate finance deals with the day-to-day operations of the business. That includes monitoring cash flows, accounting, preparing financial statements, and taxation. So what are the objectives, or we can say importance of corporate finance? This is to optimize stock price. What does that mean? The share price of that company. That is the stock price. And the strategic goal of the corporate finance management is to maximize wealth of shareholders, maximize the value of the company value, and all other strategic finance management objectives. So what are the other strategic finance management objectives that you will be seeing? So we have common equity holders and other financing investing people and other shares and bond holders and users and general public, including government. So overall the target is the strategic, tactical and operational management of the business. Strategic means the longer period of thinking ahead of that, about the business. And tactical is maybe 2 to 3 years time, how the company must go, from where we begin and where we have to end, in order to go in line with the strategic goals. And operational means it's like a budget, a yearly plan. Okay, the day-to-day operations during that current accounting period. So that is operational management plan. So even in this operational management plan, they will always keep tracking on tactical plan as well as strategic goals, whether they are in line with that or not. So accordingly, they have to make decision making. So the corporate finance must support these company strategies, like strategic, tactical, operational management of business, while ensuring that any short-term obstacles do not disturb long-term strategy. For example, during the operational period, if there is any obstacle or disturbance or any liquidity crisis, it is going to affect their long-term plans also. So that therefore they should ensure that it should not happen, or they have to make a remedial measure at once or immediately. So if you talk about overall functions, what are the day-to-day, the main task? They have to deal with risk and return of this company and long-term financial management, capital and working capital management, corporate restructuring and international finance. Therefore, in this chapter B, we will be dealing with all these 5 items in detail with some examples, questions and all these things from the examination point of view. So risk in corporate finance. First of all, we should understand risk. Risk implies a degree of uncertainty. It is not certain. Something could have happened, but what could happen, it is not certain, but it may be positive or negative, the impact on that, financial impact on that. Okay, if there is a positive, maybe it is a good one. If it is negative, it's an adverse one. So we'll have to consider accordingly. But most likely, whenever you heard the term risk, that means there is a danger feeling for everyone. So that's what, when you say risky, that means it's that way. But actually, technically, it is a degree of uncertainty that could happen, but the impact could be a positive one or maybe negative one. most likely it is a negative one. That's why the most of the concern is that about risk. So the risk can be measured by variability in returns. From the finance point of view, the risk is only about finance only, the return only. What is the return? There is a relationship between risk and return. So what could be the variability in returns due to some uncertain event occur? The greater the potential variability of returns, the riskier an investment. If there is a variability is greater, then the riskier is the investment. So normally when you put it in graph, if you see that the return in vertical and the risk in horizontal diagram, so you will see that the low risk means low return and high risk means high return. So that's how you can understand this. A 1-year US Treasury bill that provides a guaranteed rate of return on investment would be considered risk-free. The annual returns on shares of a stock or some other variable investment are inherently riskier. The return may be much less than expected or even negative. So first, let us understand the attitude of the management person, whether they are risk averse or risk lover or risk seeking. So that is an important question. See, for example, I love playing chess. I'm a chess player, but not like world FIDE rank this, but local, just local with family and friends. But even social club, I used to go and play. I take even sacrificing queen sacrifice or bishop sacrifice, knight sacrifice, play like that, taking much risk. Why? Because even if I don't go with the winning cup, my wife is going to serve me anyway with a cup in the house. She is going to give me tea or coffee, so there is no problem. So I can just project myself like a hero, like I'm a risk lover, and play in chess. That's another thing. But when I put in my money into business, that is something different, totally different. So so that's how in the business we have to see whether he is a risk averse or risk lover, how it is, or whether he is a risk neutral. So that's what we are all going to see that things. But these diagrams also show that when for example, cash is lowest risk and lowest in return compared to the other investment items. So that is the thing. And supposing you see the government bonds, it is higher in risk and higher in return, and then higher yield fixed income, then larger company shares, and then small company shares and venture capital. So this is how it goes like that. So the more you go up, it is more riskier and more return. So that's how the trend is there. Return, that is income from investments. Return is income received by an investor on an investment. Rate of return is expressed as a percentage of the principal amount invested, and the amount of return on an investment is a function of three things. That is amount invested, length of time that amount is invested, whether it is 1 year, 2 years, that is the length of time, and the rate of return on the investment, that is the percentage of interest rate, quoted as annual rate. So depending on the type of investment, all of those things can vary, like amount invested and length of time can be varying, and also the interest rate can be varying depending on the risk and return aspects. So the formula for annual rate of return calculation is the return received for 1 year's investment divided by average balance of amount invested. So we will see how average balance of amount invested can be calculated. In a normal thing, that the average balance of amount invested can be calculated from the opening balance and the end balance, add together and divide by 2. But whereas in various financial instruments investment. So it depends on the actual period that the investment is held, and accordingly the average period of that investment can be calculated. Not all returns end up as financial gains. There may be a loss also. Return reflects any change in market prices for the investment as well as interest or dividends received from the investment, and usually are expressed as a percentage of the beginning market price of the investment. For example, in the beginning, if it is 100, and at the end of that investment period, if it is 110, so that 10 is the return. Based on that 100 is the principal amount. So it depends on that kind of calculation. Simply, a return is calculated as the change in market price plus any cash payments received in the form of dividends or interest. For example, if it is a bond or debt equity, so it is debt kind of things, instrument, it will be interest. Whereas if it is equity kind of things, it will be dividend. And that dividend or interest divided by the beginning price of the security. That's how we calculate the return, the rate of return. The rate of return also called the holding period return. That means for this period holding where the investment has been held, and what is the return on that investment. So holding period return. In short form, it is HPR. For common stock, over one period is calculated with the return equal. So the P, that is the stock price at the end of the period. For example, if the stock price is 110, so it is 110 minus the stock price at the beginning of the period. So that is T minus 1 year before the beginning of the period. So that is, for example, if it is 100 in the beginning, so it is 100. So actual difference comes to 10. That is the price difference. Plus, if there is cash dividend at the end of the time period, if there was any dividend received, so that is DT. So that is cash dividend at the end of the time period. So that will be added and divided by the base price of that stock. So that is PT minus 1. So that's how the holding period return is calculated. Some example. Assume that an investor buys a share of common stock for $20 exactly 1 year ago. That means the beginning period. And the stock price rises to 22. That is at the end of the period price. So the difference is $2. During the period, the company pays a $2 cash dividend per share. So that is dividend portion. What is the 1 year rate of return for this stock? So from this simple calculation, we know that P1 is 22 and PT minus 1, which is the beginning period, is $20. So the dividend, cash dividend, is $2. So according to the formula that we studied earlier, so it is 22 minus 20, which is 2, plus 2, which is the dividend. So it is 4. 4 by principal, the beginning period stock value is $20. So it is 20%. 4 by 20 is 20%. So important rules when calculating rate of return. These are the important rules. When the income received is for an investment that was held for less than 1 full year, the amount of income must be annualized. Example, if the income is for 6 months, we multiply it by 2 because there are 2 6 months period in a year. So actually the rate of return is calculated in percentage per annum. So accordingly we have to annualize whenever if it is amount is given and the period is given. The amount invested used in the calculation must be the average balance of the amount. So we have to take the average balance of the amount as amount invested. During whatever period of time the funds were invested up to 1 year. So we have to calculate. So how do we see that? the funds were invested for less than one full year, we assume in order to calculate the rate of return, we have to assume that as if that the amount is for full year. Average balance during the period that the funds were invested was the average balance for one full year, even though the investment was not held for full year. Okay, as if it was full year. So we have to take that way. Okay, example. An investor invests $10,000 for 1 year and earns a $500 return on the investment. At the end of 1 year, the investor receives back $10,500. So what is the investor's rate of return? So the investor return is here 500 and the base amount is $10,000. So it is 5%. So that is how we need to. So what if our investor invests $10,000 for only 6 months and earns 250 on that investment? What is the investor's rate of return now? So here it is little bit we have to understand that the rate of return when we calculate it is for 6 months only. So we have to annualize it. So that means it is 2 times of 250, which is 500. But actual investment is only $10,000 and only for 6 months. So we have to treat it that 10,000 was for full year. So that is divided by 10,000. So the rate of return is 5%. Okay, so that is the thing. So because here we are annualizing the $250 which was given for 6 months only. So that was received for 6 months. So it is there are in a year there are 2 periods of 6 months. So it is 2 times. So we get 500 which is the return. But actual investment was only for 6 months. So we treat that as for the whole year. So that's the idea. Okay. Suppose our investor invests $10,000 for 3 months. Okay. Then withdrew $4,000 and leaves the remaining $6,000 on deposit for another 3 months. In fact, his investment was remaining for total 6 months only. 3 months it was 10,000, another 3 months only 6,000 on deposit. At the end of 6 months, the investor withdraws the remaining 6,000 along with income received of 200. So he received only income as 200 and he kept that fund for 6 months only. Initially 3 months it is 10,000, another 3 months it was for 6,000 because we withdrew 4,000. So this is the situation. Now what is the rate of return calculation? So here what we should take is that first the average balance of the investment we have to take it. So for 10,000 it was 3 months period and 6,000 was for 3 months period. So overall it is 30 plus 18 which is 48 and divided by 6 months. So it is 8,000 is the average balance of the investment. The amount of income received for those 6 months was 200 and that is equal to 400 because it is only 6 months income is 200. We have to annualize it. So therefore we get 2 times. So we get 400. So that 400 divided by $8,000 become 5% is the annual rate of return. So this is how the annual rate of return is achieved. The average balance of the investment over 6 months term we first calculate and we get $8,000 and then we annualize the return received for 1 year which is 400, then 400 divided by 8,000 so that we get the annual rate of return. So return relationship, the risk and return relationship. Return is the primary reason for financial investment. So why do we invest? Because of the return on the investment for which. And but there is a risk for which risk is an important consideration. We have to think about it, we have to consider, and we have to react it according to our uh, estimated risk based on our attitude. Okay, making such for making such financial decisions. Under rational market conditions, those investments with greater expected risk should provide a higher expected rate of return. When there is a greater expected risk, there is higher rate of return than investment with lower risk. Return to investors typically are a reflection of the risk they take. That's the important thing. If you don't want to take risk, you are risk aversion and you want to be a conservative, you just take a normal treasury bill kind of investment and stay safe at home. Okay, that's a different thing. But if you are aggressive, if you are risk taker, so it is a different thing. So you enter into the market and study properly and do that. So here is the graphical diagram that shows how the risk and return relationship can be thought about. Normally, as I said, that like treasury bill and all these things, money market or government treasuries will have a lower risk and lower returns. US treasury bill and US government securities that mature in less than 1 year and are very safe securities, offering the most conservative rate of return. Okay, no risk of default. Due to its short maturity period, the prices are relatively stable even though they are subject to inflation. Okay, but low risk and low return. But US government bonds and corporate investment grade bonds, like uh, highly rated grade bonds that we'll be studying later in this part of the lecture, have longer maturity periods with higher rate of return than treasury bills. So then we can increase that way, like if the risk also little increase and return also increase. Government bonds have no risk of default, but corporate bonds have relatively riskier. Okay, there is an inverse relationship between the movement of bond prices and interest rates. Like for example, if the interest rate is increasing, the bond price will be decreasing. If the bond price is increasing and the interest rate will be declining. So there is an inverse relationship between the movement. Historically, corporate bonds rate of return greater than government bonds, and even the government bonds rate is greater than the treasury bills rate of return. So that's how like this, because the return is more and the risk is also more. Stocks provide investments on ownership position or equity position in a corporation. When you buy blue chip or the small cap equities and all these things, it is you become a owner and you get profit dividends. Investors have direct share in the risk of the firm. So you are taking also, as when you take equity shares, when you are investing on the equity instruments, you take also the risk. You become the owner. You take the risk of the firm. The returns are significantly higher also because you get the profit. If the promising company, you get the higher return than the safe rates of the return from treasury bills or bonds. Historically, returns from small US firms is greater than returns from large US firms. Why? Because there is a risk is high also. In the small US firms, risk is higher than the large US firms also there. So returns also like that. Also, returns on common stocks are higher than returns on preferred stocks. Okay, preferred stocks are like conservative compared to common stocks. Okay, where there are higher returns, there are also higher risk, and vice versa. So, types of investment risk, we can study that what is the systematic risk and unsystematic risk. So, we have also earlier studied that what is meant by systematic risk and unsystematic risk, and here also we can see actually the systematic risk is about a market risk. In the market risk, it is not in the company's hand, the corporation that where you are working. You cannot change the market position. You cannot, because you are one in thousands. You cannot do that way. Okay, maybe you'll have a minute level of impact on your movement to the market, but it's not that much. You cannot diversify based on the market impact. So that is why it is called undiversifiable. It is a systematic risk. And then you have an unsystematic risk that is controllable, diversifiable, and it is a company risk within your company. So that is the total risk is the total of systematic risk and unsystematic risk. So we will be seeing in little detail further. So you have to see systematic risk. What is that systematic risk? In the meaning of systematic risk is the risk faced by all firms inherently and also called as market risk. It is naturally the market risk. Okay, it is inherent. Changes in the economy as a whole, such as the business cycle, affects all players in the market. Okay, also it is referred as undiversifiable risk, because since all investment securities are affected, this risk cannot be offset through portfolio diversification. You cannot do anything on this kind of way, because what you can do is that within your company level, it is more likely external to your company, but you are within the market, so it is you are also affected by. That's the idea. So example like interest rate risk, inflation, unemployment, oil price change, all these things affect the whole economy. Okay, the market, particular market. If the oil price change may be affecting the transport industry, the transport market also. So like these kind of things, there will be changes. Like a pandemic situation affecting the whole market also. Systematic risk is the risk inherent in a particular investment security and also called a company risk. Particular company aspects it is. This type of risk is determined by the issuer's industry, and it can be about the industry, products, customer loyalty, degree of leverage or financial leverage, and management competence, etc. It is diversifiable risk, as this risk can be offset by portfolio diversification. You can, like in the previous lecture, we saw that we can manage through a portfolio, and where there is a high risk, you can bring it down, or maybe high return, and you can put two different types of financial instruments which are moving in opposite direction, so that you can balance the portfolio risk. So that kind of things you can do it. You can make diversification. Okay, so that's why unsystematic risk can be controllable in such a way. Examples for these is increases in operational cost of particular company, workers strike, employee turnover, etc. All these things can be called as unsystematic risk. Other types of investment risk like credit risk, default risk, foreign exchange risk, interest rate risk, industry risk, political risk, liquidity risk. We can study in little bit detail about these kind of risks also. Okay, we can also study about market risk, which we studied just now about systematic risk, and we will see in little more detail. Okay. So what is credit risk, or we can say default risk? That the user of a debt, the borrower, will default. That means he will not pay the interest and or principal when they come due. This risk can be gauged by the use of credit rating. Gauge means it's kind of measurement of its worth and risk level. Okay, so there are rating agencies. From this we can get to know what is, if there is any default risk or credit risk based on that ratings. Okay, credit ratings. The higher the credit risk perceived by the lender, the higher the interest rate the lender will require in order to lend the money. So when I want to lend you your corporate company, so if I see that you are having a higher credit risk or default risk, then either I will not give that lending, or if I give, then maybe I will have to take that risk with a higher rate of interest. It is of particular concern to investors in bonds. Securities that are issued by stable governments will have the lowest level of credit or default risk, like US Treasury bills. Okay, so they are government, so they have safe uh, investment area. Okay, so less risky and less return. Okay, usually deemed to be default risk free. There is no default risk. Foreign exchange risk. The risk of fluctuations in exchange rates are called foreign exchange risk. The fluctuations, like foreign exchange rate can be dollar to rupee or dollar to British pound. So it will be fluctuations, and if there is high fluctuation, there is high risk. So that's how it should be taken. A general rule is that if the foreign currency value of an exposed item is fixed, exposure identically equals that value. There are certain countries where they fix their currency exchange rate with kind of dollar or euro and things like that. For example, in the Arab countries like Saudi Riyal or UAE dirham, they are fixed with the US dollar. So it is always the exchange rate is the same calculation. For example, 3.673 is the dirham rate against $1. So it is always there calculation, but it is fixed. So there is no this foreign exchange risk there, because this general rule is there, because it is fixed already. There is no particular exposure. Okay, because the value is same, remain same. But otherwise, there are risks. For example, 1st January we place equipment order for cost of euro 100,000. So euro to dollar exchange rate is 1.1, for example. So dollar equivalent value of that time, when 1st of January, when we place the equipment order, is dollar 110,000. We place the equipment. But right. And on 1st of April, okay, after 3 months, when we pay the supplier invoice, so we have to pay only euro 100,000 euro, because the equipment purchased in euro, which is 100,000, we pay that 100,000 euro. But in the market, the euro to dollar exchange rate was 1.2, not 1.1. It is changed. So it is equivalent to dollar $120,000. We have to pay $120,000. So therefore, the negative impact of transaction exposure is dollar 10,000. For example, maybe it consider a loss. Okay, so that is the exchange loss. That's exchange risk. And interest rate risk. The risk of fluctuations in market rate of interest, like exchange fluctuation in exchange rate is one exchange risk, and like that, if there is a market rate of interest is fluctuating, then there is a interest rate risk affecting the value of an interest bearing asset. Any bond or anything affected by this interest rate, so there is a risk on that. In general, the longer the time until the maturity, longer maturity time, the greater the degree of interest rates. Because it is longer, the maturity is longer, the fluctuation of interest rate is volatile, that means changing. So there will be a greater risk. Supposing what if the rate is getting down and our investment is for the longer period, we can't do something. Okay, so that is until we get the payment back. So that is the thing of this kind of issue. In order to minimize interest rate risk, marketable securities should be invested with short-term maturities. So we have to invest on with short-term maturities, so that we can, depending on the interest rate changes, so we can sell or buy. So accordingly, we can control also. We can take a rational decision on our investment portfolio. So that is also possible. For example, a bond was paying 6% interest and was purchased when the market rate of interest was 5%. At the time of purchase, this bond provided a return greater than the market rate, 1% greater. Could be expected in the market, okay? Because market is 5%, but you got the bond was paying 6%. So the price, therefore, the price of the bond was attracted to the investor. So they will be ready to pay little higher also, pay the price of the bond's face value, little higher also. They can buy because it is 1% interest is more. So that's why. However, after a number of years, if the market rate of interest moved to 8%, if the market rate of interest is higher than the bond paying 6%, then there is no attraction for that bond because the market is paying better. So this investment is now providing a smaller return than the market. Because its return is now worse than the smaller investment alternatives, its price must fall to below its face value. So now everybody want to buy this bond, they will be ready to pay only lesser amount, discounted amount only, okay, to the face value. And what is industry risk? The industry means, it's a combined set of various companies within the one single or a group of range of common products, areas of concern. Okay, the combined set of risks particular to an industry, for example, spike in fuel prices will negatively affect the airline industry. So that is the way the industry is affected. The whole industry is affected. Companies that are in emerging industries must overcome many barriers to entry if they are to become profitable. What is mean by emerging industry? An emerging industry refers to companies that are formed around a new product or idea that is in the early stage of development. Because in the early stage of development, normally those companies need to spend more on the research and development. There will be a lot of regulatory barriers and lack of sufficient funding will be also one of the problem. Okay, and also maybe the concerns inability to take advantage of economies of scale. Like, large economies of scale, when we talk about, it should be large scale investment, so bring a lot of benefits out of that. But in the emerging industry, the new concept, new ideas, when you do that, you have to first few years you have to do it as a steady period. You will not do large investment there. Okay, so you have to gradually study and gradually invest on that, increase your investment on that. So due to such kind of reasons, the earning capacity will not be that attractive, and there will be a lot of risk, lot of barriers will be there. Okay, so industry risk affects almost all companies in that particular industry. Okay, for example, emerging industry, you can say artificial intelligence, robotics, and kind of things, self-driving cars, like, a lot of things can be there, biotechnology oriented things like that. Political risk, the risk that political decisions may complicate the operations and profitability of business. That is the political risk. For example, changes in tax laws, environmental regulations, expropriation of assets, etc., and demonetization, like what happened in India. It's all like, political risk. And liquidity risk, the risk that the security cannot be sold on short notice for its market value. Okay. Yeah, political risk can also include blockage of funds transfers. Countries say that from this country or that country, they give sanctions against, and inconvertible currency exchange blockage for one particular country's currency. So all these things can come. Government bureaucracy, regulations, and taxes, corruptions like bribery, all these things will affect. For example, multinational companies coming to from US to various countries like India, China, and all these things. If corruptions are there in their way, and it will complicate that thing. So that is a political risk also. In addition, the multinational corporation might not understand the foreign country's business culture also. That is also one of the things. It is important to have managers with the international expertise. So that is also important. Not every multinational company can place only Americans speaking in only American language and that things. So, but it is better to have that kind of multinational, multicultural environment is always essential for the global environment. So that is important. So market risk, or we studied already systematic risk, is a non-diversifiable risk that affects the performance of the entire market simultaneously. Civil unrest, hurricanes, volcanic eruptions, political instability, economic sanctions, floods, all these things affects the market position. The risk that a portfolio's value will decrease due to changes in market risk factors, including stock prices, interest rates, foreign exchange rates, and commodity prices, or due to geopolitical events, or recessions, is all falling under market risk, systematic risk. So risk and return attitudes. Now we are going to see how an attitude of risk and return should be there for the management or the investors. Evaluating the trade-offs between the risk and return. So we have to evaluate the trade, the how we can say optimal the capital strategy, the capital structure, how you can do that, how you can put your investment portfolio. So you have to evaluate the trade-offs between risk and the return. So if more risk, more return, less risk, less return. How you can trade off and where you can see the optimum level. So that is a major component in the maximization of shareholders' wealth. So that's actually the business. Shareholder wealth is the market value of a company's common stock, also called as market capitalization. So supposing if you have a share capital value is 150 and there are 10,000 shares, so you multiply that $150 multiply by 10,000 shares, so you get the value of the company or the value of that stock portfolio, that these things. So that is called market capitalization of that company. So here we are talking about not the face value or par value, it is the market value of that particular share. It can be different than the par value or face value. So shareholders' wealth is formula is calculated is like number of common stocks outstanding into market price per share. So that's how like that. So shareholders' wealth maximization is based on the premise that wealth improves as the market price per share increases. If the market price per share is increased in the market, so that means the company wealth is improving directly. Shareholders' wealth maximization is a long-term goal because suddenly you cannot do. The short term, it is only profit for any company. 1 year period, it is profit, profit maximization. But wealth maximization or the company reputation maximization is the longer-term goal. You have to achieve that. And it is also based on cash flows, not just by book profit. Actual cash flows should be there. Shareholder wealth maximization is used instead of profit maximization in the long run, but profit maximization is short-term goal as it focuses on profits in the current year. Achieving the largest profit is most often done at the cost of long-term goals and future profits. So if you get the largest profit in a year, maybe directly or indirectly you will be knowing that you will be doing it at the cost of long-term goals. Maybe you will lose some reputation or a kind of some long-term cost involved on that. Or maybe you will have to sacrifice the future profits. So it has to be stable. If you want to have a maximum growth in the long run, you have to go stable, okay, taking good reputation in the market. Because if you are just only aggressive on your pricing or any other strategy, maybe you will lose that once competitors are coming strongly. So that is important. So the owners, that means the shareholders of the firm and managers of the firm might have different attitude problems because the profit maximization versus the wealth and social responsibility concepts and reputation goals. That is the thing. So, if, for example, the management team, maybe they are part of the management team, maybe salaried employees, and they will have the profit maximization so that they get the bonus and other things. But whereas the shareholders' goal is different, maybe. Okay, so that kind of things will be steady properly. Certainty equivalent. Certainty equivalent is a measurement, is a concept that describes the amount of cash an investor would have to receive to be indifferent between the payoff and a given risk. So that is the measurement. The certainty equivalent factor is used to convert a projected cash flow into a certain cash flow. So how do you calculate that? So when the certainty equivalent is less than expected value, that means the risk attitude is that risk aversion, means adverse position is present. It means they are afraid of risk. If the certainty equivalent value is expected, so they want to they agree that it is the certainty equivalent is less than the expected value. So that means they are risk averse. Okay. Equal to expected value, that is risk indifference. Okay, their expected value or that their certainty equivalent, the agreed value is equivalent, that means they are neutral in position. But greater than expected value, that means risk preference. So expected value is one amount, but they want to have greater, the certainty equivalent is greater their expectation level, than the expectation level. That means they are seeking positions, they are seeking a risk also in order to have a higher return. So that is there. So that is this preference is present there. Whether the expected return on investment is sufficient to entice an investor depends on the risk and returns of alternative investments and the investor's attitude towards risk. Whether the expected return and what is sufficient for the investor, that is the certainty equivalent amount, is based on the attitude of the owner, the who is taking risk, the attitude towards risk, whether it is a risk aversion or risk neutral or risk seeking or risk loving. So such attitude towards risk can be broadly classified as risk aversion, risk neutral, and risk seeking. Okay, that is the, you call it as a behavior or attitude, or the style, the management style, or the the desire of the business. Risk and return attitudes. Let's see about risk aversion. Most serious investors are risk averse. So most of the investors, okay. Such investors avoid risk as much as they can. They don't. They are like, you can say, conservative type also. They prefer lower rate of return with no risk rather than a high rate of return with higher risk. As they are afraid to bear any kind of loss in their investments. They don't want to. They have a diminishing marginal utility for wealth. So their taste, their desire for wealth is diminishing. Due to this risk aversion, risky securities must have higher expected returns. Okay, so if there is a higher expected returns only on a situation where this risk, the people with risk aversion can opt for this kind of uh, financial instrument. A risk neutral investor adopts an expected value approach because she regards the utility of a gain as equal to the disutility of loss of the same amount. For example, the such kind of investors like risk neutral neither take too much risk nor avoid risk. They take a calculated risk because they don't want to bear heavy losses. They usually take medium risk and they want to get a medium or high rate of return. So that's how they do that. It is a limiting case between risk averse and risk seeking. So medium, middle position. These individuals will have acceptable levels of risk bearing ability such that large losses are not of concern. But at the same time, achieving the highest outcome is not the focus either. They don't want large losses also, high outcome also they don't want. So they don't want to take high risk or high return. They don't want to take very low risk, low return. They want to be in a neutral position. A risk-seeking investor has an optimistic attitude towards risk. They are risk lovers. They accept greater economic uncertainty in exchange for the potential of high returns. They say they don't mind risk, but as long as there is a high profit, high earning. She regards the utility of a gain as exceeding the disutility of a loss of the same amount. So, if there is a good return possibilities, so they are willing to take that challenge. Risk can be measured in either absolute terms or relative terms. Okay, absolute terms means it's in full, or relative terms means it's only to relevant aspects. So the absolute measure of risk is usually expressed by means of the standard deviation of probably expected future returns. So what is standard deviation? From the mean value, the weighted average or mean value, if the deviations can be measured, and then we arrive at the standard deviation of the probability of the expected future returns. The relative measure of risk, that is the amount of risk when compared with the risk of other assets, is expressed by the coefficient of variation. So we need in relation with another stock, with another asset. Okay, so what is the, so we get that coefficient of variation. Investment A and investment B put together and we get the coefficient of variation. So that is how it should be studied. Absolute measurement of risk. There are two types of probability. One is objective probabilities, another one subjective probabilities. Objective probabilities are determined using either logic or actual experience. Example, when flipping a coin, the probability of the coin coming up heads is 50%. So like that we say one or head or tail kind of things. So that is objective probabilities. Subjective probabilities, on the other hand, are determined using estimates based on judgment and past experience. Like weather forecasts often include the subjective probability of rain. In finance, also, the subjective probability can indicate the degree of confidence a person has that some event will occur based on the trend that we get, we guess, or an exchange rate will be reached, or a particular price of, for a share of stock will be reached. So this is based on the trend we study and we get that. A probability distribution is a set of possible values that a random variable, example return on investment, can take and the likelihood that each will occur. So that is the probability distribution. So why do we take the probability distribution? Based on the probability distribution, we have to take the variation analysis and then we get the standard deviation, and from there we have to calculate the measures of the risk and return. Three major descriptive statistical measures in a probability distributions are expected return, standard deviation, and coefficient of variation. So let's see these three measures in detail. So the calculation of expected return, it is given by a formula. It is actually the weighted average of all the possible investment returns, where the weights represent the probabilities of occurrence. So I have given an example in the next slide so we can understand better. It is a measure of central tendency of a probability distribution. the formula for expected return is given by this. So the expected return is denoted by the symbol return, and then this sigma of the total, the weighted average of all the possible investment returns multiplied by the probabilities. So that we will see this. Thus, the expected return of an investment with a normal distribution is the mean or weighted average of the distribution with the probabilities of each return serving as the weighting. So we multiply by the weighting in order to get the weighted average. Let's see this example. Following are the possible returns and probabilities of each of those returns occurring. So we get that. So return is like possible return is 10% and the probability of that item, that case occurring is 10%. And probability of return, the possibility of return is 2%, probability is 15%. So like that we have the table given. So there are 5 times. So based on this, we calculate the expected return. So we take the percentage. Now in doing all of the calculation that follow, we must express all percentage as decimals. Otherwise, the decimal point in the final standard deviation is calculated will be in the wrong place. So we have to first bring it to decimal, multiply it, and then bring back to percentage. So that's how we have to do it. So the solution is given here. So when we want to calculate the standard deviation, we take the square root of the variance, and it is a statistical measure of the variation or dispersion around the most likely expected return on investment. It measures the variability of a distribution around the mean average and is computed as the square root of the variance. Okay, my friends, honestly speaking, I'm not talking about mathematics here. What we do is, as a businessman, we have to use the mathematical formula, which are already proven by statisticians and mathematicians. We take that as a tool for economic decision making. So we need to touch these kind of things up to that level. But provided that you are already a mathematical student, I am not. So you can go into more. But from the examination point of view, what is more important is that if you know the formula and if you know how to apply it and if you know to interpret the outcome according to the business strategy. Okay, so that from the strategic management point of view, that's how the things is there. So the larger the standard deviation for a particular investment is, that's the main part, the greater the variation among possible returns. So the larger the standard deviation for a particular investment, the greater the variation among possible returns is, and thus the riskier the investment is. That's a thing. This is logical because if there is great degree of uncertainty as to what the expected outcome of the investment will be, there is greater risk. So another example, most of the questions given values are already given, so you have to calculate using the formulas. So continue your examples from above. We will calculate the variance and the standard deviation of this probability distribution. The expected return is 8.8% or 0.088 as calculated above. Remember, we must use the decimal equivalents of the percentages, not the percentages itself. This is very important because if we use percentages in this calculation, the decimal point in the resulting standard deviation will be in the wrong position. So we get that. So when we want to calculate the standard deviation, is given by 0.0810 and variance is given 0.00656. So because, or either we say we calculate the standard deviation is 0.0810 or 8.10%. So we calculate that. Based on the variance, we get the root and we get the 8.10% as the standard deviation. So what is important here, now statistically we have to take this figure into the next level of interpretation. That's the most important point. What we do that is, so there is, from the statistical point of view, that we know already, the common rule is that 68% probability that the actual return will fall within the range of that standard deviation. So that is, if the expected return is 8.8% and the standard deviation is plus minus 8.1%, so we can see that it will be plus minus 8.8% plus minus 8.1%. So that is the probability that it will occur within this range. In other words, there is a 68% probability that the actual return will either fall between 0.7%, which means 8.8% minus 8.1%, or 16.9%, that is 8.8% plus 8.1%. So within this range of 0.7% to 16.9%. So that is 68% probability based on this expected return. And if the deviation is two standard deviations, then it will be standard deviation multiplied by 2, that is 16.2%. So you have to adjust it. So it will be plus minus 16.2%. Okay, so accordingly it will be arranged. So that either minus 7.4% and plus 25% will be the range. If it is two, if the deviation is two standard deviations. And then we have to calculate the coefficient of variation. Why do we calculate coefficient of variation? Because it is used to measure the risk of securities relative to their expected returns and to compare the risk versus reward ratio of the different securities. When you have different securities relative to one each other, you can calculate the coefficient of variation. The coefficient of variation is a risk reward ratio. What is the standard deviation to the expected return? So that is the coefficient of variation. It measures the level of risk for each unit of return that may be expected. Calculating the coefficient of variation helps to adjust for size or scale differences of the different investments, as use of standard deviation can be misleading when comparing such size or scale of differences. So just only merely using standard deviation, it will mislead. So therefore we are looking at, when you are comparing with two different securities, you see the coefficient of variation accordingly to take the decision. That we will have more understanding with some examples also. But here is the formula that we discussed. The higher the coefficient of variation is, the greater the risk is per unit of return. So that's what we have to understand. Now example. So this is very important example, part of examination question also. For example, it is very clear, they give like investment A and investment B with the normal probability distributions have these characteristics. You are not asked to calculate anything, they are giving the values, you have to just interpret by understanding. So what is important is that the expected return is 0.06, that is 6% for investment A, and the expected return for investment B is 18%, 0.18. The standard deviation is 0.04, and for investment B it is 0.06. Now, if you are asked, okay, looking at this standard deviation, we see that investment B has more risk than investment A. Why? Because the expected return is 18, high return, but the standard deviation also high, 6% compared to investment A. So here we are looking for the risk factor, the standard deviation as the risk factor. But when we calculate the coefficient of variation, taking the expected return to the standard deviation. So what is that meaning is that though only the deviation we take, it seems to be like high risk, but there is a return, expected return also high. So accordingly, if you take the ratio, which is the coefficient of variation, so there we conclude that the investment A is more riskier than the investment B. Why? Because the expected return is lesser in investment A, relatively more lesser than taking the risk factor. Okay, so that is why we calculate the standard deviation 0.04 divided by 0.06, which is the expected return, and this side standard deviation 0.06 divided by 0.18, which is the expected return. So therefore we get the coefficient of variation, which is 0.67 one side and 0.33 for investment B. So from the value, so we get the coefficient of variation of investment A is more, therefore it is high return, high risk. Okay, it has a greater risk than investment B. One CMA adopted question. The expected rate of return for the stock of investment A is 20%, with a standard deviation is 15%. The expected rate of return for the stock of investment B is 10%, with a standard deviation is 9%. Now, which one is the riskiest stock? The same example that we have to follow here. So, for that, now the question is that, let's read this question also. The investment B, because its coefficient of variation is higher, and investment A says because its return is higher, and C, investment A, because its standard deviation is higher, D, investment B, because its standard deviation is higher. Okay, now there is two things. One, we can calculate that like the previous example and get that from the coefficient of variation, we can easily say that. Another trick is that if you understand this kind of questions, here we can knock out B, C, D because investment A, because the return is higher. So return is not the criteria to understand which to find out the riskiest stock. Okay, so B is not there, and just because the standard deviation alone cannot give a clue. Okay, so we need to go for the ratio with the return also, the standard deviation with the return to standard deviation. So we take the standard deviation by return, so that we have to go for the coefficient of variation. So accordingly, A seems to be good, but even that we can confirm. So we take the 20-15%, we calculate that. So investment A is 0.75, whereas investment B is 0.9, that means 90%. So investment B, because its coefficient of variation is higher. Thank you very much, and our next lecture will be continued about portfolio theory of risk and return and the capital assets pricing model, thus to conclude the chapter B section 1 about risk and return. Thank you very much.